Hi all, and welcome to my second lecture regarding Bitcoin education, time preference, and capital market accumulation. In this video, I will explain the first half, so we will focus on time preference. Let's start with fundamental rules. The aim of the presentation is to share the knowledge. It is not a financial advice. Every individual is fully responsible of how he decides to invest his money. Investing is risky. You can lose all your capital. Reference book, as always, is the Bitcoin Standard, is the first book I always recommend to read in order to start to understand the Bitcoin revolution. Let's start with some questions. Many people are asking why most people are not still not understanding Bitcoin revolution. The hard fact is that for a basic understanding of Bitcoin, 10 hours is enough. But for a deep understanding, it takes considerable efforts, roughly more than 100 hours of study, and barely no one has bothered so far. That's why people are full with misconceptions, or they are saying things that are not relevant for Bitcoin related to money. And why so hard? Because it is not just price, because it involves knowledge of history, finance, economics, sociology, technology, and complex math and politics. On one side, there is the history of money. On the other side, there is the blockchain, how it works. On the other, and the third part is also how the whole Bitcoin mining is topic. So it is very complex and it takes considerable time to understand, to study in order to understand it. So Bitcoin early investors benefit from this asymmetry, and what we are seeing now, the world is slowly waking up on what the Bitcoin revolution means. We hear more and more, or some institutions, or some billionaires or investors or wealthy people that are moving from skeptic to believers, and generally is more and more known among the average person. So for today, we will discuss about money and time preference. It will be the three parts: time preference, saving and capital accumulation, and 0 to 1. Let's start with money and time preference. As we discussed last week, in last lecture, sounds money are money freely chosen on the market, and they hold the value across time, space, and scales. The importance of sounds money is because two reasons. Firstly, because they protect the value across the time. In fact, lower the time preference of the individuals. Lowering time preference is what initiates the process of human civilization and allows humans to cooperate, prosper, and live in peace. And second, it allows for trade to be based on a unit of measurement, free from government control. Time preference is the ratio of which the individual value the present comparing to the future. So the more you value the present to the future, the higher your time preference. And the more you value the future instead of the present, lower is your time preference, and this is what causes human flourishing and civilization. So let's see some characteristic of time preference. So firstly, it's always positive because the future may never arrive, and for the same quantity, individuals will always choose the present. And in fact, they ask you want 100 euro now or in one day, the same quantity, it will be always the people will say now. Animal time preference is higher than human being, and the sense of investment is in fact lower time preference is the sense of investments. In fact, as human delay immediate gratification, they invest their time and resources in the production of goods which will make production more sophisticated, technology advanced, and extend it over a long time horizon. For example, if you try to go and fish, you can fish with your hand, or you can 8 hours per day, or you can spend 4 hours per day fishing and 4 hours per day developing tools that help you to become more productive. And this is an example that is in the book. So the more you spend time and delay gratification and you spend time to become more productive, the better it will be your future. Another example would be people who delay to go to work and they start to study university is for knowledge, but also to have a better future and a better job. And investment raises the productivity of the producer. The lower individual time preference, the more likely is to engage in investment, and so to delay gratification and to accumulate capital. And there was the famous marshmallow examples where there were children where they were saying they were put in front of marshmallow. They were saying you can have it now, you can have it now and eat, or you can wait a certain amount of time and then you will have to. And kids they have these two choices. And some kids decided to eat directly. Some people decided to wait, and they got two marshmallows after a certain amount of time. And the history is saying that those kids who waited were doing better in the life because they understood that it makes sense to delay the instant gratification in order for a future better future. That's the sense of time preference. So another important topic on this is that the most important economic decision to any individual's well-being are the ones they conduct in their trade-off with their future self. The most important economic decision we are doing is with our future, the future of ourself. These decisions are more important than any outside circumstances or conditions. In fact, we have people who triumphed against the odds and unfavorable circumstances, and very talented people who managed to waste all their talent. For example, some famous athletes and entertainers died poor. On the other hand, we saw many ordinary people that work diligently and have saved and invest for a lifetime to achieve a certain level of wealth. Infatti, civilization, sorry, is not about capitalization per se. It is about what capital accumulation allows human to achieve. The flourishing and freedom to seek higher meaning in life when their base needs are met and most pressing dangers averted. So um, this is not just once we have civilization, we achieved our basic need. Then the most flourishing we are is when we delay gratification and we decide to invest this time for a better future. In fact, the level of time preference depends also security and safety of the individual. First, you need to feel safe and secure, security of property, level of tax rates, and the future value of money. And this is a very important concept. So the time preference depends also on the future value of money. Meaning the reduction in the purchasing power of money is similar to a form of taxation or expropriation. And we are seeing it is now even more with inflation about 7.9% in US and between 6 and 8%, also 9% I think in Spain. So reduction in purchasing power of money is similar to a form of taxation and expropriation. With money that loses its values, society save less, accumulate less capital, and begins to consume its capital. Worker productivity stays constant or declines, and wage stagnates, even if nominal wage increase, but not catch up with the purchasing power. So these are very important. There are two very important contents topics. First, what is time preference, and then time preference is strictly connected with the future value of money. Let's go to the next part. A theoretically ideal money for a lower time preference will be the one whose supply is fixed, meaning nobody could produce more of it. The only non-criminal way to acquire money will be to produce something of value to others and exchange it with money. As everyone seeks to acquire more money, everyone works more and produce more, leading to improving material wellness for everyone, which in turn allows people to accumulate more capital and increase their productivity. So the best form of money in order to lower our time preference will be money whose supply is fixed or it is as scarce as possible. This money will work also at store of value because it's very hard to produce more, or because even better because they're fixed. And this will incentivize to save and think about the future. For 2,500 years, gold was the soundest money possible, where the new supply of money will be the least significant compared to the existing stockpiles. So for 2,500 years, gold was the soundest money possible. This it was till 2008 when Bitcoin was created. Let's introduce now the law of diminishing marginal utility. This law is saying that acquiring more of any good reduce the marginal utility of extra unit. For example, $10 extra benefit more who has an income of $100 than those who have an income of $1,000. And as people develop lower time preference overall, more people are likely to want to hold money, causing a rise in its market value compared to other goods and services, further rewarding its holders. For example, gold in UK dropped purchasing power from 1,560 to 1,700, but it was stable between 1,700 and 1,914 during the gold standard and increased the purchasing power after the 1914. So when the world was in the gold standard, the gold was stable. But then the world went off from the gold standard and gold increased even the purchasing power because it was seen as a reserve of value. In fact, we see that in the last 200 years, gold has increased its value also in terms of other commodities. Even the best performing and the most stable government form of money have witnessed their value decimated compared to gold. Whatever currency the government decide to have, this currency value decimated compared to gold, with the value currently running at 2-3% of their value in 1971, the year when they were delinked 100% from gold. So $1 now is valued 2 or 3% what the value of gold, dollars versus gold in 1971. When comparing, in fact, if we compare the prices of goods and service to the value of government money and gold, we find a significant rise in their price as expressed in government money, in dollars or in euro, but a relative stability in the price of gold. So gold maintained its value. It went more from maybe $1,300, now is $1,900, but the cost of, compared to the cost of goods and services, gold maintained the purchasing power. And the stability of money is important also for a measure as unit of account. When money is predictably stable in value, it can act as a reliable signal for changing in price of other goods. Government money are unpredictable in value in the long term because we know there will be inflation and they will deteriorate. The purchasing power will always go down, but it's not clear in the long term how much they will go down. Let's start now with the second part, saving and capital accumulation, another very important part. Sound money creates an economic environment where any positive rate of return will be favorable to the investor, as the monetary unit is likely to hold on to in this value, if not appreciate, thus strengthening the incentives to invest. So if I hold gold, gold or will keep the value or it will increase the value. So you are more influenced to hold it. With unsound money, so euro or dollars, only the returns that are higher than the rate of depreciation of the currency will be positive in the real terms, creating the incentives of high return but also high risk investment and spending. Further, an increase in money supply effectively mean low interest rates. The incentives to save and invest is diminished while the incentives to borrow increase. The more the currency or money will depreciate, you are less influenced to save and you are more influenced to borrow money. The highest savings, in fact, we see that the highest savings of the seven largest advanced economies was 12.66% in 1970 versus 3.39% in 2015, when it started to the link to the couple completely the government money from gold, so out from gold standard, we saw also a decrease of the savings of the seven largest economy. And there's also a very important topic. This is not an issue in Keynes economics because it assures citizens that debt is good for growth and that savings will result in recession and that national debt doesn't matter because it's own to ourselves. And Keynes economic, it vilified savings and deferred consumption as the key of economic perspective. So the problem is we live also in this society where Keynes economics saying to us that debt are good for growth and is vilifying savings and deferred consumption, while savings and deferred consumption are the key to economic prosperity. In fact, lending stopped being restricted to investment but has moved to consumption. In fact, it is quite ironic that that capitalism, a system based on capital accumulation from saving, is blaming for unleashing conspicuous consumption, the exact opposite of capital accumulation. In fact, many people they complain that because of capitalism we spend too much, but in reality this is against capitalism. Capitalism is means capital accumulation. And why we have this? Because we have a Keynes theory that has a big misunderstanding. In fact, the Keynesian misunderstanding considers that delaying current consumption by saving will put worker out of work and cause economic production to stall. The only cause of economic growth in the first place is delayed gratification, saving and investment, which extend the length of the production cycle and increase the productivity of the method of production, leading to better standards of living. In fact, that's the reality. In fact, our generation will be the first one since the decline of Roman Empire to come into the world with less capital than our parents. And this is because 50 years ago, we went completely out from the gold standard and governments start to print money as much as they want with some limit, but as much as they want. And also banks started to give loan not backed by anything. So increasing money supply. Whenever a bank is giving you a loan or a personal loan, this is not backed by anything or maybe just a small percentage. So it meaning is like the bank effectively is printing money. And in fact, 100 years ago, most people will pay for their house, education, marriage, or car from their own labor or accumulate savings. Such a notion seems ridiculous today. And the problem is politicians are elected for few years, and if they have the power to have short-term decision making, they will choose short-term decision making also in terms of monetary policy. In fact, under is always in the short term is always better to print money, so it apparently looks like everyone is more rich and you have a boost of the economic prosperity. But in the medium long term, is just wrong and is deteriorate the value of the currency, and it is not in favor of economic prosperity. In fact, under a sound money regime, individuals are far more likely to engage in long-term investments and to have large amount of capital available to finance the sort of project that will require a long time to pay off. Some of the most important innovation in human history were in the golden era 1870, 1914. In fact, it was the gold standard. That was the era where most of Europe were under the gold standard. So all the money that we have, the paper money we had in our hands, were backed by gold. And there is a very famous book called Zero to One. And this saying, the concept is that the move from zero to one is more important than the one to many, because it's creating things or new technology is much more important than the extending. And the word pre-1914 was the zero to one, and the post-1914 was the one to many. In fact, if you can reconvene, we use so many things that were born or they were created or invented in this period. For example, hot and cold running water, central heating, electricity, internal combustion engine, automobile or the car, airplane, city subway, elevator, heart surgery, radiation therapy, telephone, wireless, telegraphy, color photography, movies, and many others. All of them were invented or discovered in the period 1870-1914. And that's it for the first half of the second lecture. For the next lecture, we will discuss more about capital market, and we will discuss more about why Keynesian, which is the biggest misconception, and we will compare Keynesian's theory with the Austrian theory, Austrian economics. Bye.